Hey guys, welcome back to the channel. Today I wanted to introduce you guys to a model I learned about in college, and it is called the dual beta model. Essentially what it is, it's an extension of the capital asset pricing model. So this formula kind of looks similar to the CAPM model. The main differentiator is that here we are going to split our positive returns and negative returns of our benchmark, and then we're going to run a regression with a risky asset that we might hold in our portfolio to extract positive beta and negative beta along with their alphas. So I actually took a screenshot of the formula a couple of years ago, but if you go on Wikipedia, I think this formula is no longer displayed, but this is what it looks like. It's easier than it looks. So again, here we're just splitting the returns of our benchmark by using a dummy variable. So it'll be a 1 when our benchmark is positive or has positive returns, and it'll be a 0 when it has negative returns. So that's what the D is in this formula. The A's symbolize our alphas, both positive and negative. So we'll extract the betas and alphas in a regression against our risky assets. So by using this model, we actually gauge our risk better than using the capital asset pricing model, because when we use regular beta, it actually includes our positive returns in that regression, which are not considered to be risk because they're positive returns. So in essence, what we're really trying to find is risky assets that do better in downturns, and that can be symbolized by having a better positive and negative beta. So when we have a downturn, usually risky assets will move with the benchmark, but if they have a larger positive beta, then their drawdowns might be shorter than the benchmarks. Inversely, if we have a downturn, we want to find risky assets that have far less of a drawdown than our benchmark. And we can find that by looking at our negative beta. All right, so let's go to our R script. I actually have this coded out. So for this tutorial, you're just going to need QuantMod and maybe performance analytics if you want to actually display the returns. So these will be our risky assets. I'm using the SPY for our benchmark, but do note that in our hypothetical portfolio, I do have some bonds, so the SPY might not be the best benchmark, but we'll go ahead and take a look at the betas when using this benchmark. So I'll go ahead and run these two lines. I'll collect the data by using get symbols. I'll send it to a new environment. I'll merge the adjusted closes starting in December of 1994 till present. So I'll use monthly prices instead of daily returns. So I'll go ahead and run these lines. All right, so these two lines, I'm just going to calculate the returns and then plot them against each other. So if we take a look at the plot, we do see some stocks that have overall beat the benchmark. I don't even see the orange line for the SPY. So we'll go ahead and close this out. All right, so the next thing I'm going to do is I'm going to use the 10-year treasury, and that'll be our risk-free rate. So I'll use get symbols.fred. I'll start it in 1994. I have to divide by 112 to convert it to monthly, and then I'll subset the data at the end of 94 till present. And here I'm using index of my returns to subset our risk-free rate to make sure that both indexes are identical. And then if we have any NAs, I'm just going to replace those with 0. So I'll go ahead and run this block. All right, so for the actual model, I have a function which will just pass in the ticker. I'll subset my returns with the ticker. My benchmark will be SPY. I'm going to merge my risk-free rate, my benchmark, and my risky asset. And then here's where I actually do the calculation. So for the dummy variable, if the returns of my benchmark are greater than or equal to 0, I'll use a 1, otherwise use a 0. And then beta up and beta down are essentially the same thing, except that when my benchmark is positive, I'm subtracting the returns minus the risk-free rate multiplied by our dummy variable, otherwise return a 0. And then for the beta down is when our benchmark is less than 0. I'm going to subtract the risk-free rate from our benchmark returns, and then I'm going to multiply that by 1 minus the dummy variable, otherwise it'll be a 0. And then since most stocks begin trading at different dates, I came up with this line. It looks like a lot's going on, but all that it's really doing is that it'll skip all the zeros until we actually get returns for that risky asset. So that'll be an index. So then I'll run my linear model, which will be our risky asset minus our risk-free rate as the dependent variable. And for the independent variables, it'll be beta up plus beta down plus our dummy variable. After we calculate that linear model, I'm going to extract the coefficients. So the coefficients will be our positive and negative betas, our positive and negative alphas, and also our p-values. Otherwise, if there's an error, I'm just going to return zeros for all the coefficients and the p-values. And then finally, just a little formatting. So the first column will be our down alpha, and then our positive beta, and then beta down, alpha up, and then our p-values. And then I'll round everything to 4 decimal places, and then combine the ticker with our betas. All right, so I'll go ahead and minimize this function, and then I'll run it. All right, so here I'm just gonna apply this function to all the tickers by using lapply, and then I'll run do call rbind to get a nice data frame. So if we take a look at the results, we see our tickers, the positive and negative alphas and betas, along with our p-values. All right, so for our p-values, we want to see this be less than 5% to be statistically significant. So there's actually just one that is not statistically significant, which is Facebook, and a few that are kind of borderline. But for most of these, it returns 0, which is great. So what I try and find are stocks that have a better positive beta and a lower negative beta. So if we take a look at Apple, we see that we have a positive beta of 1.25. So what this means is usually when the S&P rises, Apple tends to rise even further than our benchmark. And when the S&P goes down, we can expect to see that Apple actually doesn't go down as much as our benchmark. So I think this is a better way of gauging our betas. And I do see that for TLT, these are negative, and that just means that this asset moves inversely with our benchmark. And then our alphas just symbolize the returns that cannot be explained in this regression. So we do see a positive alpha of approximately 2% for Apple against a negative alpha of 0.3%. All right, guys, so this concludes this video. I hope this was informative. I'll post the link down in the description area so you can go ahead and download the script. Let me know if you have any questions. And again, thanks for watching.